This is the first in a two-part video series on the installment method of accounting. Now, what is the installment method of accounting? Personally, I feel it would be easier to illustrate this to you than to give you a giant long explanation. So let's start very simply. We have a gentleman, his name is Bill, and he owns a dump truck manufacturing company. As a matter of fact, he has a factory, and the only thing they produce in that factory is dump trucks. Okay? Now, he gets a phone call from Tom. Now, Tom owns a construction company, and Tom tells Bill he needs $500,000 worth of dump trucks shipped to his construction company right away. And Bill agrees. Now, Bill already knows that Tom's construction company is not the most financially stable construction company of all time. All right? Matter of fact, it's not a financially stable company at all. So Bill draws up a contract which Tom signs, and it says that Tom will pay Bill a certain amount of money each and every year until the dump trucks are paid off. Now you say, well, that's accounts receivable, right? Not if it's an uncertain sale. That's the key. This is not a certain sale. Bill may get so much from Tom one year and not get anything after that, because Tom's construction company may go belly up, and Bill may have to take control of those dump trucks again after just shipping them to Tom's construction company. See what I mean? So this is kind of an uncertain sale. Alright. But Bill decides he's going to take a risk with Tom, and he's going to do this anyway, because he doesn't want $500,000 worth of dump trucks just sitting in his warehouse. It'd be better to try to ship them off than to just have them in his warehouse. Now, Bill does retain ownership of the dump trucks until Tom completely pays them off. Okay? Alright, so here's how this one works. Bill values the dump trucks at $500,000. Now, it costs Bill some money to manufacture those dump trucks. It actually costs Bill $300,000 to manufacture those dump trucks. Now, Bill has to make a profit on these dump trucks, or he's not going to be in business very long. That's why he said, all right, it cost me $300,000 to make them, but I'm going to charge Tom $500,000 so I can actually have something to live on. I got to pay my employees, I got to pay myself, so on and so forth. Alright, so that's going to leave a gross profit for Bill of $200,000, which is good for his business. Alright, now, let's say this was shipped in 2014. Tom pays Bill in 2014 $75,000 for the dump trucks. So yes, Tom owes a lot of money to Bill. Okay? And if Tom does not pay the full amount to Bill, Bill will eventually repossess the dump trucks, because Bill technically still has ownership of the dump trucks. Alright. Now, how do we calculate the rate of gross profit? Okay? Well, we take the gross profit, which is $200,000, and we divide it by the installment sale of $500,000, which makes 40%. So Bill is making a 40% profit off of these dump trucks if he can get all the money back from Tom. And that's kind of tricky. Alright, so what happens next? Well, we know that Bill is going to get a 40% return on those dump trucks once all that money's paid back. So he takes that 40% times that $75,000 and gets $30,000. Okay? So Bill has made a $30,000 profit so far from the dump trucks in 2014. Now, why are all these numbers important? Well, I'm going to explain that in my next video. So I definitely want you to stay tuned for that.